Welcome traders to the Polaris Trading Group's PTG University Indicator Review. Today's indicator we're going to look at is the central pivot zone, but on a 3-day basis. We refer to that on our charts as a 3D CPZ. It identifies a key price zone for a 3-day rolling trade session. So the 3-day central pivot zone, 3D CPZ, is a rolling average of the central pivot zone. It represents a key price zone that is utilized by large institutional money managers and hedge fund traders. Polaris Trading Group's member education uncovers the how and why Mr. Big uses this zone. Now, there may be many of you out there that are not aware of the fact that, or even heard of, the 3-day central pivot zone. The central pivot zone itself is a very common calculation. The 3-day rolling average of this central pivot zone is not commonly used by the retail trader. It is, though, utilized by the large institutional money manager and hedge funds. Let's take a look at the charts and see what it looks like. Okay, so the chart that we have here is a 60-minute 24-hour session S&P E-mini futures, and the overlay here is the 3-day rolling average of the central pivot zone. Okay, so if you recall, the central pivot zone itself is the high-low close divided by 3, and what we do is we add a midpoint level to create a symmetrical zone. What the 3-day rolling central pivot is a 3-day average of each of those central pivots. So it formulates a very important area and zone to trade from. Now these are zones that the large institutions utilize for support and resistance. Okay, so just to show you an example here, we had a period of consolidation where the 3-day central pivot zone became very, very narrow. And when we have a cluster, if you will, of 3-day central pivot zones, that is telling us that the market is in a position to make a move. The market is compressed, and there's an expansion move coming. And so you can see here in the S&P minis, they sold off, and the 3-day central pivot zone, remember this is a rolling average now. All right, it started descending along with price, which is normal. Now when you get a price corrective move, you can see here that price corrected up to a prior 3-day central pivot zone. That became a sell point or a resistance supply point, and the institutions took advantage of that. And you can see on the flip side here that as long as there's descending 3-day central pivot zones, a directional trend is underway. Once price exceeds 2 central pivot zones, the market is anticipated or expected to have shifted from a downtrend, in this case, to an uptrend. And as you can see, price continued to move higher over the next several sessions, and the 3-day rolling central pivot zone, as expected, right, trailed accordingly. Now, when we saw price pull back to the 3-day central pivot zone in this location, it acted as a support point. So the big institutions use that pullback as an opportunity to add to positions. There was also an opportunity here, you can see on the next session, pulled back right to the top of the 3-day central pivot zone. And again, buyers stepped in and bought that zone. So this is not normally used by retail traders, but here at Polaris Trading Group, we seek to use the tools that I've come to know and use over my 25 years of experience working on behalf of the institutional traders. We bring that to our trading membership, and we utilize the same tools that the large institutions trade. So the 3-day central pivot zone becomes a very important tool and support point and resistance points for the big institutions, and this particular indicator measures those zones. Hope this helps. We'll see everybody at the next indicator update.